RBI has just made loans more cheaper for you. Yes, you heard it right. RBI has slashed yet again repo rate of the country.
Today, the Reserve Bank has made a call on that system. They have decided to cut the repo rate. It has been reduced by 25 basis points. Earlier, it was 5.5%. Now it is 5.25%.
Reserve Bank of India may announce a 25 basis point cut in the repo rate during its upcoming Monetary Policy Committee meet starting today until August 6th.
Now the repo rate stands at 5.25%, which means from 5.5% earlier, repo rate has been slashed by 25 basis point to 5.25%, making loans in the country more cheaper and more credit available to the public at cheaper rate so that you can get credit cheaply and then you can contribute towards consumption and investment in the economy, and so that the GDP of the country can grow, which can lead to economic growth, and eventually it can lead to India becoming developed by the year 2047. Now, what do you mean by repo rate? Why repo rate is significant? What will be the impact of this recent slash in the repo rate? And what is monetary policy? And what are the instruments, other instruments than repo rate of the monetary policy? All these things we'll be trying to understand in today's session. Hello, my name is Preetpal Singh and all of you are watching Perspective. Now, if we look at it in a very clear way, repo rate simply means the rate at which central bank of the country lends money to the commercial banks of the country. Now, let us take an example. For us individuals, who's the banker? The banker is the commercial banks. But for commercial banks, who's the banker? The banker is the RBI, which means when we need to borrow money, we borrow money from the commercial banks. When commercial banks need to borrow money, they borrow it from the RBI. Now, when commercial banks borrow money from the RBI, the rate at which RBI lends the money to the commercial bank is what we call as repo rate. Now, if you can remember, when we go to the bank and ask for loans, does bank give us loan freely? Or is bank asking for a collateral? Bank is definitely asking for a security or a collateral. Now, if similarly, the commercial banks are going to the RBI to ask for loan under repo rate, is RBI going to give them loan free? No. RBI is also going to ask for a collateral or a security in return. And which is why in a repo rate, collateral has to be given by the commercial bank to the RBI in order to secure a loan at a repo rate. And the repo rate recently has been slashed from 5.5% to 5.25% in our country. So again, conclusively saying, repo rate is the rate at which central bank lends money to the commercial bank. In India, repo rate is the rate at which RBI would lend money to all the commercial banks like HDFC, ICICI, SBI, PNB, PSB, or whatever bank. Now, there is one more rate alongside repo rate which is very popular. That rate is known as a bank rate. Now, bank rate is similar to repo rate, of course, but there are two minute changes. One minute change is that a repo rate is usually for short term, which means short-term borrowings can be done under repo rate. But there is one more rate known as bank rate that is for long-term borrowings. Also, one more difference is there that under repo rate, there is a collateral requirement. But under bank rate, famous thing is that there is a no collateral requirement at all, which is again a very important part of the difference between a repo rate and bank rate. Now, once we are able to understand the difference between the two, let us try to understand how both of them are a part of monetary policy. Now, before we delve into that, what you must know is that this repo rate directly impacts the lending rate of commercial banks to the people. See how the chain is framed. When RBI lends money to the commercial banks, they lend at a rate known as repo rate. When commercial bank lends money to the people, they lend at a lending rate. Now, the rate at which RBI lends to the commercial bank is impacting the rate at which commercial bank lends to the public. Now, for example, RBI starts charging more to the commercial banks. For commercial banks, loan will become expensive. Commercial banks will also in turn start charging more from the public, because indication has come from whom? Come from RBI. Now, if RBI slashes the rate, RBI comes down with the rate for the commercial banks. Now, commercial banks can take money from the RBI cheaply. If commercial banks can take money from the RBI cheaply, commercial bank needs to provide that benefit to the public as well. And now public also eventually would be able to take loans from the commercial bank easily and at a cheaper rate. That is the impact of decrease in repo rate in the economy. So simply speaking about the impact of this repo rate cut, it will significantly boost the borrowings in our country because it is going to reduce the lending rates across different banks. Now, if lending rate across different banks are reduced, people are willing to take more credit than before. And people definitely would be tempted to use that extra money either for consumption or for investment. Now, one thing is very clear. Lower repo rates means lower interest rate for loans in the country. Now, lower interest rate for loans in the country, it encourages borrowing. And because of borrowing, borrowing by the consumers and the businesses both. It stimulates investment and consumption in the economy because it stimulates investment and consumption in the economy, which if we see through expenditure method are very integral parts of GDP. So if investment and consumption goes up, the overall GDP of the country is also likely to go up. And if the overall GDP also goes up, economic growth of the country achieves a higher level, which is why from 6 to 7% on average, we'll be able to grow 8 to 9% on an average if we continue to do this, continue to reduce the repo rate in our country. So till now we have understood about repo rate, we have understood about bank rate, and we have understood about the impact of a repo rate in the economy. Now let us try to talk about another rate which is opposite of repo rate. We call it as reverse repo rate. Now reverse repo rate means the rate at which commercial banks can park their excess funds with the RBI. Now, when commercial banks park their excess fund with the RBI, commercial bank would also want a collateral from the RBI in turn. And that rate at which commercial bank park their excess funds with the RBI is what we call as a reverse repo rate. Now, both these instruments are part of the quantitative instruments of monetary policy of India. Now, monetary policy is the policy of the government of India, economic policy of the government of India. And that monetary policy can be of two instruments. One is quantitative instruments, another is qualitative instruments. Under quantitative instruments, there are three different headings. One is ratios, another is rates, and third is open market operations. Now, once ratios are done, there is a second component known as rates. Now, rates again are of two types. One is repo rate and one is reverse repo rate. Now, repo rate we have already covered. Now, simply speaking, reverse repo rate is the rate at which commercial banks, they park their excess funds with the RBI in turn of requirement of a collateral as well, which is bizarre of course, but still RBI gives collateral to the banks who have deposited money with the RBI. Or which means when the banks have parked their excess funds with the RBI. But here there is a very problematic situation that in a reverse repo rate, the rate at which you can park, the commercial banks can park their excess funds with the RBI, that rate is very huge. No, that rate is lesser than the repo rate of the country. But the problem here is just one, that under reverse repo rate, RBI has to give a collateral to the commercial bank, which is definitely not acceptable at all. Which is why in the April of 2022, a new system was devised which was known as a standing deposit facility, known as SDF rate. Now, standing deposit facility is somewhat similar to the reverse repo rate itself, which means in standing deposit facility as well, commercial bank can park their excess funds with the RBI, but the only difference is that in standing deposit facility, RBI need not give any collateral. Now let's try to understand this one more time. In reverse repo rate, there is a collateral requirement which the RBI has to give the commercial banks when commercial banks park their excess funds. But in standing deposit facility, this is no longer the case. In standing deposit facility, RBI does not need to give anything as collateral. And since it is more beneficial to the RBI, it has since then replaced the effectively reverse repo rate in the country. Now, one thing we can very clearly note down here is that all this repo rate, bank rate, reverse repo rate, or all the other things as well, they are all a part of monetary policy framework of the country. Now, this monetary policy framework, conducting this monetary policy framework or implementing it is the part of monetary policy committee, which was again formed in the year 2016. Now, according to this monetary policy committee, monetary policy is set in India, and monetary policy is having two instruments. One is quantitative, another is qualitative. Under quantitative, there is one instrument known as ratios, that is two ratios, CRR and SLR, which we'll do separately sometime. Then there are two rates, that is the repo rate and the reverse repo rate, and third is open market operations. That is the third instrument of monetary policy. Under qualitative instruments of monetary policy, again there are few components. The first one is margin requirement, the second one is moral suasion, and the third one is credit rationing. Combine all of this is known as monetary policy of India. And who's responsible for monetary policy of India? Monetary Policy Committee, which came into force in 2016, and it is a 6-member committee which meets bi-monthly, and which is why in India monetary policy comes a bi-monthly basis, which means how many times a year? 6 times a year we have monetary policy. And what is the reason? The reason is to adjust to the reforms and adjust to the contemporary realities which are happening at real time. Now, this monetary policy committee is the same committee which was recommended by Urjit Patel committee in order to solve this reform and solve this menace of the crisis which was going back then. Which is why this recent repo rate cut move by the RBI is a very laudable one, because it will just do one simple thing. It will make loans cheaper for the public. Now, once it makes loans cheaper for the public would be able to get more loans, public will be able to get more credit, and once that happens, public will be able to spend more, they'll be able to invest more, businesses would be able to invest more into different avenues, and which is why it will lead to stupendous economic growth, leading to increase in GDP of our country, and economic prosperity. And our vision to become developed by the year 2047 would also be achievable. I hope you gained a new perspective from this session. Do let me know what are your views regarding it. All the very best and have a beautiful day. Thank you.